Welcome back, ladies and gentlemen. What's going on, Sam Brown, Steve, Jonesy, Peter, Jana? Welcome back, folks. Give people a moment to jump in the stream since we just popped it up. It's the 1, 2, 3, 4-year anniversary of when these criminals pulled the buy button. So I think it's fitting that we talk about short squeezes. Let's talk about short squeezes in depth. Welcome back, John Doe. It's good to see you, brother. Let me drop the link for this in the Discord as well. So everybody in the think tank has an opportunity to join in. Forgot to do that. Share it on Twitter. Sue Ray, let's go, my man. Black Widow's still here. Hello, Paula. It's great to see you as always, my friend. Let's go. Guitar and stuff. How those Trump coins doing? They're being meme coins, my friend. They're acting like meme coins act. What's up, Ronnie? Welcome back, brother. Cheese Does Gaming. I was there. They canceled my automated selling of stock the day AMC hit the peak. I set to sell a bit before the peak hours in advance in preparation. They canceled them tight as it hit the money. That is wild, my friend. Good morning, Sue Ray. It's good to see you. Now we're going to talk, of course, a bit about what are short squeezes, how do they occur, some historical examples, social media and increased retail participation, and of course, the future of short squeezes. Because Lord knows, it's not looking good for a lot of these short hedge funds. Hey, Matt, welcome to the stream. I'm glad you were able to make it, brother. Hey, Crypto Femme. Dave, welcome back, my friends. Here's just a nice little screenshot of a few of the 50 plus securities that were made position close only when most of the world's top brokerages, including Robinhood, IBKR, Charles Schwab, E-Trade, etc., removed retail investors' ability to buy these stocks. AMC, BlackBerry, Bed Bath & Beyond, Express, GameStop, Koss, Naked, Nokia, Sundial, and many, many more. You can see here they said, for GameStop and AMC options expiring Friday, we wanted to reach out to you in light of the unprecedented volatility surrounding GameStop and AMC Entertainment Holdings. In an effort to help reduce risk, we've begun implementing certain restrictions for GME and AMC options trading. And Robinhood said, effective immediately, all GME and AMC options with expirations of January 29th, 2021 will be set to closing transactions only. Additionally, our standard sellout procedures on GME and AMC have been adjusted to account for the increased risk. Because of this, your positions are at a higher chance than usual of being closed out if you are unable or choose not to close out the positions yourself. If we determine that your option contract is at risk of being in the money and you don't maintain the necessary collateral to support assignment/exercise, we may take proactive measures to help reduce your account risk, including closing at-risk positions prior to the expiration date. This may also include, but isn't limited to, spread positions with a theoretical max gain and loss. Of course, they're talking about options contracts and securities, shares of stock. Please note that having the collateral to place the trade is different from having the collateral to support exercise/assignment. Of course, They would not give retail investors the ability to add. Let me fix this webcam real quick. They wouldn't give them the ability to add cash to their accounts because these guys didn't want retail to have the money to exercise their contracts, as exercising call contracts would force Robinhood to buy more shares of stock of AMC and GameStop, as you guys would know. And they were already on the precipice of complete collapse. Ishmael Ghani says, is your opinion the short squeeze still on for AMC and GameStop? I own 6 figures of both, my friend, and I've been holding them for a long, long time. Let's put it that way. I'll be happy to hold them as long as necessary. Paula, Cash Money is doing well. Thank you for asking. Brian, welcome back, brother. And Pilot says, good afternoon, boss and crew from 28,000 feet. We got you streaming on the 60-inch in the rear cabin. Counterfeit securities everywhere. That is fantastic, my friend. Have a safe flight. Let's take a quick peek into this. So reality is they didn't have sufficient cash to buy the necessary shares. So their answer to this was to sell your shares and sell your contracts without giving retail the investors the ability to to add funds in order to meet the requirements. Whereas obviously that would be very possible through a wire transfer. The money would be arrived the same day if retail investors wanted to exercise some of their calls. They could have definitely done that. Keenan Haywood, welcome, my friend. Yeah, the think tank says hello. Check this out, folks. Our good friend Black Man Boating on Twitter, always coming out with the fire. Here's what we've got. Let me zoom in a little bit for you guys so you guys can see this better. He says the Security Exchange Commission writes off billions in already low, ridiculous fines that they can't collect. And he is correct. They have written off over $10 billion worth of uncollectible fines. Why would these financial criminals that illegally naked short companies stop illegally naked shorting, he asks. Owners of AMC, GameStop, DJT, and goes on to list a few others. We have the same criminal enemies. And here is just to show you guys just how aware they are of the situation. Is Senator Ted Kaufman speaking on naked shorts way back in 2008. Because this problem hasn't gone anywhere. It's just gotten many, many times worse. Listen up.
Naked short selling is another matter altogether. It occurs when someone sells a stock they do not own and have not borrowed. Naked short selling creates 2 risks in the marketplace. The seller may not be able to deliver the necessary shares on the delivery date, and bad actors can manipulate stocks downward, repeatedly selling something they do not own. Naked short selling, without first borrowing or obtaining a so-called hard locate of the shares, essentially increases the number of shares in the market, which tends to lower the value of the stock. It is exactly like if I made 3 copies of my car's title and then sold the title to 3 different people. By the time I sold my 3rd title, it would likely be impossible to deliver the car to the 3rd buyer, and its value would also have declined. When Bear Stearns and Lehman started to crumble, many believed manipulative, naked short sellers, using a series of large and frequent short sales known as bear raids, helped drive both firms into the ground. Bear Stearns stock dropped from $57 to $3 in 3 days. Let me repeat. Bear Stearns stock dropped from $57 to $3 in just 3 days. When Lehman collapsed, an astonishing 32.8 million shares in the company have been sold short and not delivered on time. The SEC has proven incapable of both preventing market manipulation from happening and punishing those who are responsible for it. Mr. President, we cannot allow this to continue. At a recent SEC roundtable, major problems with the current regulatory structure were exposed. Even the panelists heavily stacked in favor of industry admitted that compliance with the local locate requirement is widely ignored. And Commissioner Elise Walter acknowledged prosecuting naked short sellings on the reasonable belief standard is a very difficult case to bring. Because the reasonable belief standard is unenforceable, abusive short sellers are essentially free to engage in criminal activities without fearing of facing criminal prosecution. Mr. President, the SEC's silence speaks volumes. They have given no indication there will ever be action. Nothing from the SEC strategic plan to various speeches by SEC executives acknowledges that this is a priority. Clearly, the cost of inaction in this area is too great to ignore. Accordingly, I urge my colleagues to join Senators Isaacson, Tester, Specter, Chambliss, and me as co-sponsors of S-605, which requires the SEC to move quickly to address naked short selling by reinstating the substance of the prior uptick rule and requiring traders to obtain a contractual hard locate before selling short. We need to send a strong message to the SEC that the United States Congress will not tolerate inaction on this critical issue.
Naked short selling is a national security failure. It is a massive threat to the national security in the United States and to investors around the world. And most people don't even know it. Most people have no idea that that's the case, but it is really a massive problem. Let's talk about real quick about some of the key players here. Short sellers. Short sellers, as you guys know, are investors who bet against the stock, borrow and sell shares that they do not own, which is not in itself a crime. But if the stock price rises, they incur significant losses. As a matter of fact, they are unlimited potential losses. It becomes a crime when they don't borrow that stock or they fail to deliver when that stock needs to be returned. If there is no locate, it's a naked short and it's massively illegal. But the Securities Exchange Commission knew about it in 2008. And even though they tried to make minor changes in the market to help, the fact is that it hasn't helped at all. Now you got retail. Individual investors who buy stocks, often in large numbers, sometimes coordinated through social media. Their collective buying power can trigger or accelerate a short squeeze. And then institutions. Hedge funds and large firms that may hold short positions or invest in a stocks alongside. Some institutions capitalize on a squeeze by entering positions ahead of a surge. Front-running the trades, ladies and gentlemen. Front-running the trades. Something that will likely never end. I posted this just a couple months ago here. And you can see that from the date of this article, 2005, hedge funds were unable to short sell stocks because they could not meet the requirements. And a stock brokerage, RYCO, registered as a market maker in order to short sell stocks on behalf of hedge funds, registering as a market maker of certain securities way back in 2005. Now that's the same thing that Citadel has been accused of doing with GameStop and AMC. Selling short the stock through their hedge fund and market maker in order to benefit each other, manipulating the prices of securities. Look, NASD charges Pennsylvania brokerage with impermissible short selling scheme. The scheme maintained short positions in OTC stocks on behalf of 3 hedge funds. Huge, right? The National Association of Securities Dealers announced that they charged a former brokerage firm with engaging in a long-term widespread scheme of short selling activity on behalf of 3 hedge fund clients. They've been doing this not just for a couple of years. They've been doing this for decades. And we really have to have significant change in these markets. But as I've told you guys, they're not going to make these changes in order to help people. We have to make change for ourselves. Hence why we're creating the stock brokerage firm, Lit Exchange. Volkswagen briefly became the world's most valuable company when Porsche's stake in the company caused a supply shortage of available shares, leading to a massive short squeeze. Volkswagen owned only 55% of all available shares. And I mean Porsche. Porsche owned 55% of all shares of Volkswagen. Today, retail investors own over 90% of all AMC stock. Are you beginning to understand a little bit about why GameStop and AMC are such a massive issue for these guys? Remember, Volkswagen became the world's most valuable company, where their market cap shot up to more than Berkshire Hathaway, more than any of the biggest financial institutions you can think of, all because of 55% ownership. I'll be right back. Rex West says, oof, Robin Hood ads. Yeah, my friend, that's the hilarious thing, right? Ronnie says, at what point are we going to the streets and making some noise, boss? My friend, I think retail investors have been making noise on social media and all across financial markets for a significant period of time. We have been, and in case you didn't remember, even myself has been out to the Macy's Day Parade with digital billboards, thanks to Cash Striker and all of you retail investors that have participated in funding that and setting that up. We've done our part on social media, getting the word out to millions of users. And it's a lot more powerful than going out to the streets, I'll tell you that much. GameStop, a coordinated effort by retail investors, primarily from the Reddit community Wall Street Bets, led to a surge in GameStop stock price, forcing hedge funds with short positions to cover at steep losses. Now, ladies and gentlemen, you and I are both very well aware that this is directly related to a lot of the over-leveraging from Melvin Capital. Melvin Capital and their friends shorted GameStop hundreds of percentages over the actual float. And they forgot to use swaps and other derivatives to hide their short interest because they got greedy. That bit them in the ass. Now, dozens, if not hundreds of firms have gone bankrupt directly due to having shorted GameStop and AMC. Similar to GameStop, AMC saw a dramatic price surge driven by retail investors rallying on social media platforms, leading to a squeeze on institutional short sellers. We saw GameStop and AMC increase by over 2,000% on multiple occasions. In January 28th of 2021, 4 years ago, the anniversary of the buy button being pulled, and also in May and June of 2021. Even more recently, all the way as recently as May of 2024, we saw GameStop and AMC both have some incredibly massive runs that were shortchanged as well. Yes, Jason, by the way. So we can go into detail on these stocks, but we've talked about them in huge depth on this channel already. So you guys probably already know everything I'm going to tell you, or most of you know what I would tell you about AMC and GameStop, including the fact that they are incredibly good deals and undervalued right now. The power of social media and retail investors is huge, folks. Absolutely huge. And remember, JP Morgan has been fined time and time again, as many of these firms. JP Morgan was fined nearly $350 million for inadequate monitoring practices, which meant that they allowed market manipulation and naked shorting to occur in their dark pools. Again, they were fined a $348.2 million by the Federal Reserve last year over an inadequate program to monitor firm and client trading activities for market misconduct. This occurred not only for a few days, but a decade, from 2014 to 2023, according to the Federal Reserve. They also had to pay $98.2 million fine from the Federal Reserve. The board is requiring the bank to review and, of course, fix these issues. They did not admit guilt and signed a waiver, and paid a small fine. Help us take orders out of dark pools and process them on lit markets to prevent manipulation at litexchange.com. That was March 14th of 2024. And you can see that it happened over and over and over again with these firms. They were also fined later in 2024, $3 million additional dollars for other violations. M1 Finance, the brokerage, was cooking the books and naked shorting tens of millions of orders from 2016 through 2024. 12 million short sales without locating securities and inaccurately marking those orders as long. They took out short positions without a borrow, which means naked shorted, for practically a decade, the better part of a decade as well, through M1 Finance, the brokerage. Then they marked their liabilities as an asset. They cooked the books. If people did this, if you did this, for example, you'd go to federal prison. And of course, by inaccurately recording these short sales and another 3.5 million principal buy orders as executed in an aging capacity, they maintained inaccurate books and records and violated Exchange Act Section 17A, etc., and FINRA Acts. And of course, they got a slap on the wrist. $400,000 was all they had to pay for tens of millions of short sales, naked short sales, and mismarking principal buy orders. Cooking the books, naked shorting, is a game that is never going to stop. If you were using a brokerage that automatically routed your order to lit markets, M1 Finance is a brokerage, and others like them, JP Morgan, etc., wouldn't have the opportunity to do that. That's one of the major importances of using a brokerage like Lit Exchange, an upcoming brokerage. You can see Robert F. Kennedy tweeted me and several other retail investors on this post of his from last year. He says, I'm very aware of what the average retail investor has been saying about the need for greater transparency in our markets, stronger regulatory oversight, and tougher penalties for market manipulation, criminal behavior. My admin will support the Ape Retail Rebellion and enact aggressive Wall Street reforms. Now, we know that RFK Jr. is not the president, but he's the next best thing. He's making America healthy again as a right-hand man of that guy, Donald Trump, our president of the United States, who was shot in the fucking head for simply running for office to help the American people. And so far, in his first week, it has been the best first week in the history of presidents of the United States of America, and probably any country in the world. And of course, RFK invested $24,000 of GameStop into GameStop from the fees he earned from suing Monsanto. Now, you can think of that however you will. The fact of the matter is that he's invested in the company, and he used Monsanto's own money to do it. He also came out and asked me about it and helped us and had me help, as well as some of these other retail investors that you see here, to help them craft possible reforms for the stock market, which I've shown you on this channel in the past as well. So I'm not going to go into detail on that. But social media like Twitter that you're seeing here, Reddit, Discord, have become tools that we need in order not to coordinate buying activity, But in order for people to share information and details, what you decide to do with that information is your prerogative. If you decide to buy, hold, or sell based off the information available on the internet, that's your prerogative. But without social media, we wouldn't be able to share that information. So this has, of course, significantly altered the landscape in trading. And that's another one of the things that I think is going to really excite people with the coming lit exchange. If it seems like, wow, why does he keep mentioning lit exchange? It's because it's really important for retail investors to have a brokerage that's not constantly out to screw them at every turn. That's why we're creating it for retail, by retail. The power of social media has increased market volatility, making things a lot more volatile, a lot larger price swings, creating gamma ramps, delta hedging by brokerages and market makers, and FOMO buying by other retail investors, which creates massive short squeezes like we saw with Volkswagen and GameStop and AMC. So when people tell me that, oh, GameStop or AMC can't go up to this number because of the market cap, I will tell you guys that market cap doesn't mean a fucking thing when it comes to a stock squeezing. The potential losses for short hedge funds, market makers, broker dealers, clearinghouses, etc., is immeasurable. It's infinite. That's what gives these kinds of companies and these short squeezes the ability to achieve new highs. Of course, these institutions need to adapt because retail is adapting. Our trading strategies are adapting. And people are becoming smarter to the fear, uncertainty, doubt, and short and distort campaigns that are out there lying to others. And a lot of people are going to fall for the lies, but a select few won't. And those are the people that have, by and large, made significant profits during times of massive volatility. And we know the SEC and the CFTC and such have started paying more attention, right, to the market manipulation. But we have found that, at least under the Biden administration and Chair Gensler, they really slapped lipstick on a pig. They didn't really do enough to actually make markets better. They did try to enact some things like the Consolidated Audit Trail, which is great. They have gone after some market manipulators and short sellers when they've committed crimes, such as Citron Capital's Andrew Left, who is currently facing 370 years in federal prison. The fact of the matter is, that the impact of increased retail participation has been great for everybody in the stock market. Let's take a look at the market sentiment in meme stocks. Whereas it used to be fundamentals that affected the stock market. As you guys look at things right now, you can see stocks with good fundamentals that are incredibly overvalued. And then other stocks that have increased their fundamentals and made their fundamentals better, increased their profitability, paid down their debts, increased their cash position and financial runway, they are still undervalued. That is a big part of the current issues with short selling. Market challenges, market volatility can cause extreme price fluctuations. leading to major losses for both short sellers and buyers. Price manipulation. Some efforts may blur the line between organic market movements, which are very rarely organic since high frequency trading is constantly front running trades, and potential market manipulation, which is, of course, happening all the time with naked short selling as well. So even though this regulatory attention is being attracted, it's greatly insufficient to actually making any real systemic changes. And yes, there is massive systemic risk because it does impact broader market stability. And when broader market stability is impacted by outside factors, like things that we saw just yesterday with the yen carry trade being blamed on DeepSeek AI's information that we've known about for several weeks, of course, there can be massive short squeezes as well. It's a double-edged sword there. Now, what do we think is going to happen for the future? Higher scrutiny and restrictions on short selling and media-driven trading. And I would be all for this, as would many other people I know in the stock market as well, because there is not anywhere near enough oversight against naked short selling other than slaps on the wrist. $400,000 fines are insufficient for nearly a decade of short selling. Even for JP Morgan, who's doing billions and hundreds of billions of shares traded, if not trillions over decades, $348 million fine is insufficient. Imagine how much profit they made off of that to be able to pay the $350 million without a problem. You should expect a significant advancements in AI-driven trading. Much like what we've seen with DeepSeek, there is a good possibility already that for retail investors to use artificial intelligence, bots and such coded by other retail investors that are with the aid of AI like DeepSeek in order to shift market dynamics here, folks. And the problem is here that people think that commission-free trades are really good for them, but the reality of the fact is they don't realize that their trades are constantly being front-run by high-frequency trading algorithms, by the brokerages, by the market makers. Because when anything is free, you are the product. You get worse execution, which means shittier prices when it comes to buying and selling. And your orders are internalized by market makers and wholesalers like Citadel and Virtue. They can be traded within their dark pools called alternative trading systems. They profit, you don't. You still spend money on the commissions, except it's more expensive. Now, we already talked about the long-term market implications already. Now, why is this important? Because people need to understand that you can make a significant amount of money off of short squeezes. And if you're a paper-handed bitch, you could also lose a lot of money if you sell at the wrong time. So sometimes people forget that stock squeezes like Tesla, for example, can take a significant period of time. Others, such as dry ships, DRYS, can take a significant period of time. Volkswagen, etc. We need to go back in time and examine that even more recently as AMC, GameStop, Tesla, MicroStrategies, and even further back going to dry ships and Volkswagen, etc. Short squeezes take a lot longer than some people think. It's not always over in a heartbeat. So due to the fact that a lot of these players are not playing by the rules, it gets dragged on further and further by failing to deliver, by improperly processing trades, by making trades over the counter when they shouldn't be and using derivatives to hide their short interest. Short squeezes are often dragged over significantly long periods of time. And that's why a guy like Warren Buffett tells you, quote, do not even think about investing in a stock for 10 minutes if you're not interested in holding that stock for 10 years. And what Warren Buffett means by that quote is, don't play with anything that you're not interested in holding for a long period of time. So when I hear people complaining about AMC or GameStop being naked shorted or being a significantly longer hold than they expected, I tell them, unfortunately, that's a bit of a rookie move. I was well aware when I first invested into AMC and GameStop, and when I put six figures worth of money, cash, into these companies, that there is a possibility that this could last a long time. This could last a lot longer than many people expect, but I am more than capable, willing, and able to hold on to these stocks for as long as necessary. A lot of people, sadly, invested money they could not afford to lose, or even worse, invested money that they could not afford to let sit on the sidelines to actually work for them. For as long as necessary, and had to liquidate. Now, that's an unfortunate reality in life, that if you can't afford to let your money sit in the stock market, you probably shouldn't put it in the stock market at all. Now, I will say, if you have money to invest and would like to invest it in the stock market, but are concerned about the overvaluations currently seen, you should check out Lit Exchange. You can go to litexchange.com. The link is posted in the chat right now, and it'll be down in the comments in the description. We have a Regulation CF campaign for founding members, which means that we are, through the Jobs Act of 2012, for the first time in history, an upcoming stock brokerage is giving you the opportunity to own part of the company. This is going to give you a lot of benefits and perks that nobody else will have the opportunity to get. And of course, we will prioritize transparency, efficiency, and accessibility. You can be an early supporter and gain potentially gain significantly long-term benefits. When we do IPO in the future, as we plan to do, you would then have a chance to sell off your stock, your ownership in Lit Exchange, and have a liquidity event. Check this out. Donald Trump on Truth Social actually even said, rather than support our common sense efforts to promote transparency and compliance, Citadel Securities bizarrely targeted our CEO with an unhinged attack. Here's our response. Citadel Securities, a corporate behemoth that has been fined and censured for an incredibly wide range of offenses, and is world famous for screwing over everyday retail investors at the behest of other corporations, is the last company on earth that should lecture anyone on integrity. No surprise there at all. Grandpa Barney, thanks my friend, continues to say, bought more again today at the bottom. LMFAO. Boss, I love these prices. AMC is at stupid low prices. You know what, to be honest with you, my guy, I have to completely agree. For the potential that the company has, for their increased cash flow and massive payments towards their debts, as well as a very comfortable cash position and financial runway, thanks to the smart issuance of shares that occurred from the CEO and board of directors, keeping the company alive and preventing retail investors, including myself, from whose investment would have gone to zero if the company had gone bankrupt, which would have happened had AMC not issued shares on the open market. It was a very smart move. They were able to push out their debt through 2030. GameStop was able to pay off their debt in its entirety. And now AMC has over $500 million in cash on hand. GameStop has over $4 billion in cash on hand. AMC is a profitable company who has had multiple profitable quarters last year and would have had profitable quarters every quarter last year if they hadn't reinvested a lot of their net profits back into upgrading their theaters. GameStop, who is revolutionizing their company right now from the ground up, both are incredible value plays. And now, this is not financial advice. You should not invest in either company unless you do your due diligence and make your own decisions. But I do personally believe that they are incredibly good values, deep fucking values, if you will. Let's listen to Charles Gridante, if you want to, for a few minutes. Because Charles Gridante here is a veteran on Wall Street of over 5 decades. This man has been running a hedge fund for nearly 50 years. And in this, he literally called out Citadel Securities while sitting right next to them. At first, this does start out a little fuzzy with his microphone, but the information he's saying is really important. So you should be paying attention.
It's not reported properly in the media, that's for sure. The media would let you believe that it was that we need to regulate meme stocks, we need to regulate retail traders. But in fact, there's another side of the story which points in a different direction. I think we've all been suspicious when we've seen high volume call buying followed by the stock rising within a week or so, maybe days sometimes, could be even a month. But we associate the rise in the stock with the excessive call buying and sort of make the conclusion that it's very suspicious. The excessive call volume leads to the underlying stock increasing. That is true in part, but there are other things going on. When one party is long the call, they have an asset. There's a counterparty that is short the call, and they have a liability. The market makers typically marry people that are doing covered calls with traders that are going long a call. So you have one side going long a call, the market maker looks for someone selling a call and marries the two positions and makes a market. If you have high volume call buying, which is not illegal, the market maker takes the position himself. And as I'm reading the media, you never hear much about market makers doing this. I mean, they pointed to Citadel, but they don't really explain what goes on. The excessive call buying forces Citadel or any other market maker to take the other side position. So now you have the retail traders in GameStop long the call, and you have Citadel or some other market maker short the call. The market maker has an option to do nothing or hedge. Typically, market makers don't like to take overnight positions, and most of these calls were for at least 1 day or more. So they will hedge that position, and the hedge of being short a call is to buy the underlying stock. That is what moves the stock. So in as much as we can marry long call buyers with covered call sellers, nothing happens to the underlying stock other than information flow about the stock causing the stock to go up for fundamental reasons or technical reasons, momentum, moving day average, whatever. But insofar as the volume on the long side exceeds the natural offsetting volume on the short side, the selling side, the market maker steps in, must hedge their position, and that creates the balloon up. Now,
at this moment, in case you didn't understand what he was saying, retail investors owned a vast number of long call contracts on GameStop, AMC, etc. He's talking about GameStop specifically because that's what the question is about here. And the same goes for AMC, and we've proven that due to the risk assessments that we've seen come out in the GameStop report. That, as a matter of fact, there was an even larger, a 400% larger risk to Robinhood than due to AMC than to GameStop. Now, this isn't a competition here because, as you guys know, we have been heavily covering both for a significant period of time. So really, it's a comparison so that people understand that this is more than one stock. And anybody out there who is telling you that, only one stock matters is honestly a bit naive and troubled in the head. But the fact is, retail had a ton of long calls. And the reason that Robinhood was forced, or should I say, forced you to sell your calls, and they were automatically closing out your call positions and only allowed you to sell your shares of AMC, GameStop, costs, blah, 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 is because if retail had exercised their call contracts, Robinhood and all these other firms would have been completely insolvent. So much so that they robbed all of the retail investors that were invested in these companies of massive gains. He's telling you that the market makers will marry your calls the calls that you're buying with long calls being sold by somebody else. But they can also create married calls and puts, divorced calls and puts, taking the other side of the trade or the same side of the trade, depending on what they want to do. And he also said that it's not illegal for there to be massive call volume buying by retail investors. He said retail did not break the law by buying a ton of calls. That's not illegal. But it is illegal when a market maker facilitates a short position on behalf of their hedge fund.
I watch CNBC, I watch Bloomberg, I read all this stuff, and has anybody heard that explanation? Great, but I'm very disappointed, and it's not uncommon that even the regulators are just starting to, I think they understand this, the ones in senior positions, but they don't know how to handle it. Now, there are other things, and I'll give it back to you but there are other things that need to be discussed in the situation because the market maker, in an effort to support now the short seller, Melvin Capital, they will typically borrow the stock, as I think everybody here knows that. They borrow the stock, give it to the short seller. They actually sell it. It never goes to the short seller. Everything stays on the books of the market maker. They sell the stock. They put the cash on their books, memo credit to Melvin Capital, and that's collateral against the short. And that's the typical short selling. But that's not what happened with GameStop. It did in the beginning, but when the shorting got out of hand on the hedge fund side of the fence, the market makers created synthetic shorts. And that's a whole other issue, and we can talk about that. But the synthetic shorting and naked shorting, which is illegal, a market maker can execute naked shorts insofar as they're facilitating a trade. They're not to facilitate someone shorting a position for an extended period of time. So the regulators are looking at that now as to whether or not there was this naked shorting by the market makers on behalf of the hedge funds in order to facilitate the shorts. And I think they're going to uncover that there were some issues there, which gets me to a final point. I'll give it back to you. The penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and all of the players get fined constantly for doing.
Look at this guy. Dollar store Liam Neeson over here. He works for Citadel. And so does this chump right here. Charles Gradante just outed him in front of everybody.
Doing this, as long as it's not intentional and never is intentional, they get fined.
Never
And
intentional.
I think one of the things we need to do is discuss increasing the fines for this lapse of memory and inefficiency in the system to the point where people wake up and pay attention. right now, the fines are insignificant. So I have more to say on that, but that's just a taste of where I'm going. Well, getting back to my points, and retail now is a big player on the street, and GameStop shows how important it is to address that sector.
Well, Charles, is that because trades are free now? I mean, back in '87, it would have cost $50 to call your broker.
It's
and
not
trade,
87.
Right? Is that why? Do you think that's incorrect?
Well, the trading was more expensive. The bid-offer spreads were wider, and most of the velocity trading was done by institutions that had a moral compass. Not that as a matter of fact, I'm in favor of what the Reddit boys did and girls. They were right in what they did, so I'm not knocking them.
And this is coming from a hedge fund manager, so that's.
But an institution would never push the system that far because the regulators would come down on them, saying, in other words, the question you have to ask yourself: well, why didn't a hedge fund do what Keith Gill did and his followers? Because a hedge fund would do that to a certain point and then cut it because the SEC would be in on them.
I see. So when the retail players rallied together, there was no. I guess there wasn't a single target, or is that why why wouldn't they be? Why wouldn't they go after them?
Well, if Goldman Sachs tried to execute a short squeeze, they have executive management that at some point would have said, "We've made enough money, now cut it out," because the SEC will be on our backs, and we don't need those two-bit no good. So that's important. Whereas the retail guys just said, "Hey, if Plotkin can short, over 100%, or Plotkin and his cohorts could short over 100% of the float, why can't we buy enough calls equal to 100% of the outstanding or the float?" So it was an even up playing field, just that the moral compass is different. The hedge funds got a little bit of a more moral compass, not that much more, but a little bit more.
Can you believe it? He actually says hedge funds have a little bit more of a moral compass than retail. And at that point, I think he's right, because the hedge funds would be like, okay, we've made a few 100%, it's time to go. And retail was more like, yeah, we made a few hundred, no wait, a couple 1,000%. Fuck the hedge funds. I'm not fucking selling.
Well, and Charles, I think you told me that it doesn't take a rocket scientist to realize there's a risk of a squeeze when you have over 100% of the
I was
flow
surprised when they had the congressional hearing that they tried to set the retail side up for a fall, but it's really the hedge fund world. I mean, and
he's talking about the GameStop report here. The Securities Exchange Commission tried to blame you, all of us as retail investors, for buying and holding a company that we love, for making profit, for doing what you're supposed to do on the market: buy low, sell high. And the Securities Exchange Commission tried to throw you under the fucking bus. Same with all the hedge funds and all the mainstream media. You do not hate these pricks enough.
Poor risk management. Once you see the exchanges reporting that 100% of the float is being shorted, and there's synthetic shorts to carry it up to 140% or thereabouts, it only takes a 10% move in the stock to start some shorters to think about covering the short. Most hedge fund managers will start covering their losses if they're long and the stock goes down 10%. At 10% is sort of the demarcation. And if they're short and it goes up 10%, they start covering. There's a simple mathematics. If the stock goes from 100 to 90, you only need 10%, 10.5% to get back to break even. So you start cutting your losses at that point. At 20%, you either double down or cut the position out altogether.
Now, Charles, I want to ask you about something I think we've discussed in the past. We're obviously very, very big fans of NASDAQ here, but I was talking to a NYSE market maker, and he said he felt sick to his stomach that day when you could only put in sell orders for that list of stocks. How did that come about?
Well, like I was alluding to before, the market makers were basically selling to Robinhood and the Reddit crowd naked calls, long, and they were short the call because it's double entry accounting. Somebody's long and somebody's short. And the market makers did not hedge in the beginning.
Oops.
But then when they started hedging, because the volume of calls went to the point where it became dangerous, the hedge to a short call is to either buy another call or buy the stock. And it's much easier to go in and buy the stock electronically than to start. So they bought the stock, and in buying the stock, they were moving the price up. And their attitude was, this call buying will stop, so let's buy the stock, hedge our current position, and hope that the buyers of these calls stop. But they didn't. They just kept going and going and going. So the buying of the long stock on the short call became the issue.
Now, he clearly tells everybody that the reason that GameStop and AMC went up in price is because retail investors bought a ton of call contracts. And because of that, the market makers were forced to hedge their positions by buying a ton of the stock. Without a lot of call buying, there is no short squeeze, period. Social media users and influencers who tell you don't buy calls because it gives market makers money are in a way correct that it does give market makers money, but it also prevents a stock from going up in price. Where they got that information, nobody knows, but a lot of people speculate that some influencers out there were paid to tell retail investors that narrative in order to get them to stop buying call contracts so that market makers and shorts would no longer have to hedge by buying those shares, preventing the stock price from going higher.
And so it got to the point where the exchanges and regulators were aware that market makers were becoming illiquid. They had to settle these trades, and they need capital to do that. And they were spending their capital, which is on the to cover the short call. And then that's what blew it. And then they had to stop buying the stock. No more buying the stock unless you're.
They had to tell retail to stop buying the stock. You were no longer allowed to buy the stock unless you're an institutional fuck like Plotkin.
Plotkin or hedge funds where you're short,
Right,
and you want to reduce your risk.
So the only ones that were allowed to buy the stock from companies like Robinhood and all the other brokerages, remember, E-Trade, Webull, Schwab, all of those, almost every single brokerage, not everyone, almost, stopped retail from buying the stock. But they continued to let you sell your shares to the institutions.
But no more buying.
Today is the
for
4-year
speculation.
anniversary
You can buy to cover a short.
of when that happened. So for retail, any retail investors to still trust any of these companies, to me, is just astounding. And that is part of the reason why we came out and have created Lit Exchange. Again, folks, the only time in history where you have the opportunity to own an upcoming stock and crypto brokerage. Because that's never happened before. No firm has ever given you that opportunity, and they likely never will, because they don't want retail to have this opportunity. Lit Exchange is different because we're created for retail by retail. We're going to have an amazing user interface that our engineering team has done a fantastic job in developing so far, that it directly incorporates artificial intelligence in a way that allows you and thousands of others to perform your due diligence and strategize in ways that's never been seen before. It allows you to protect your investments by avoiding payment for order flow from these shady dark pools. So prevents your order from being traded in a dark pool by the internalizer that is buying your orders, because we're not going to send them to the internalizers. Lit Exchange will send your orders to lit markets, to lit exchanges. This, of course, prevents manipulation of your trades and allows you to actually make an impact on the stock that you're buying or selling. It prevents you from receiving synthetic shares and IOUs in your account that are then failed to deliver by the market maker. You can view our SEC filings on the SEC Edgar website here, directly from our site as well. You can see them there for Lit Exchange with our Reg C and D and CA/NDA filings directly if you want more information. You can visit the FINRA regulated funding portal, Silicon Prairie, linked on our website and down in the description and chat below. So far, over 300 retail investors have invested over $500,000 in Lit Exchange. You can check out the pitch deck, the business plan, the independent auditor's report, offering memorandums, and just tons and tons of information about the company, myself, my partners, the due diligence involved, and so on, as well as the actual offerings themselves and all of the benefits that are involved there. So, ladies and gentlemen, I will leave you with that. I wish you peace and wealth. Make sure you're properly hedged and look into investing in Lit Exchange. Thanks for joining me, everybody. I appreciate all you guys. Grandpa Barney, yeah, I know the look on that guy's face was insane. Can't fucking believe that guy in the slightest. I'll leave you with a word from our guy here, Elon Musk, and then follow it up with Gary Gensler admitting to you that commission-free trades are not free and dark pools are free legal market manipulation for these guys.
I want to be clear, I do not respect the SEC.
We made the decision in the morning to limit the buying of about 13 securities on our platform. So we're really in unprecedented times. In order to protect the firm, we had to limit buying.
That markets are efficient because of active managers setting the prices of securities. Firms like Citadel, we're all running large teams of people that are engaged in fundamental research, trying to drive the value of companies towards where we think they should be valued.
Sam Bankman-Fried and FTX, he's been charged by U.S. courts and the SEC with money laundering, conspiracy to commit wire fraud, and securities fraud for the collapse of FTX. The former chairman of NASDAQ, Bernie Madoff, built the largest Ponzi scheme in history. Over 4 decades, he faked records of annual gains to investors who thought he was investing their funds, when in fact, he was just using new investor capital to pay off older investors.
But the synthetic shorting and naked shorting, which is illegal, market maker can execute naked shorts insofar as they're facilitating a trade. The regulators are looking at that now as to whether or not there was this naked shorting by the market makers on behalf of the hedge funds in order to facilitate the shorts. And I think they're going to uncover that there were some issues there. But the penalty for naked shorting is really not significant enough to stop it. Citadel and Goldman and all of the players get fined constantly for doing this.
Hedge funds and other Wall Street firms have teams of analysts working together to compile research and analyze shares of companies. Individual investors do not have those resources.
I basically would like to ask the SEC why they didn't act on the morning of January 28th, because I was so scared, I can't tell you how scared I was. I was so scared, I can't tell you how scared I was.
Well, Thomas, what were you scared about? What does failure look like? You said we came close to breaking. What were you scared of?
I was scared of a domino bankruptcy. I tell you, the rules require the long brokers to go into the market and buy the shares at whatever price. So that drove the shares up to $480, and then suddenly it didn't go further, but it could have gone further.
So buying and selling those 200 shares would make the market maker $1. But as millions of shares are traded, the profits from the spread add up. In 2020, these brokerages collected almost $2.6 billion in payments for stock and option orders.
These brokers, including Interactive Brokers and Robinhood, that generate revenue from selling the order flow to market makers.
Business has always been done like this on Wall Street for over 100 years.
Our orders compete against each other to get the best prices. But if the order instead is routed to a wholesaler that has agreed to pay for it, the order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.
As you mentioned about commission or zero commission does not mean it's free. It does have some cost inside. Some brokers have payment for order flow.
Disclosure alone, by enhancing the disclosure around payment for order flow, really will address it. United Kingdom, Canada, Australia, all have banned payment for order flow. I know we have different markets, different systems. We even have letters that we've gotten over the years, dating back over the last 20 years, articulating why it's not good for our system. So I really ask staff to consider that, but also to consider it only in the context of the entire market structure.
On January 28th, our daily deposit requirement was 10 times more than on January 25th. As a result, Robinhood Securities imposed temporary trading restrictions on certain securities. Robinhood Securities put the restrictions in place in an effort to meet increased regulatory deposit requirements.
The decision to restrict trading really was internal to Robinhood. We did not have discussions about that.
Like GameStop, AMC, all these meme stocks have brought naked short selling really to the forefront of the market's interest. This is something that's going on for a very long time in the small cap market and is very much a problem.
Has your husband ever made a stock purchase or sale based on information you've received from you?
No, absolutely not. Okay, thank you. Thank you.
Those are fully collateralized tokens.
That markets are efficient because of active managers setting the prices of securities.
The order is not going to an exchange and is not necessarily receiving the benefit of that broader competition.